Okay, welcome back everyone, and welcome back to those who are joining us online. Great to have you with us. Just a reminder, and I'll try and remind you again at the end of this session, at the end of this panel we'll be going into our parallel sessions. So some of those sessions will be in this room, the rest will be on the 4th floor. And so if you walk sort of along the corridor, you'll see a lift, so just go up to the 4th floor. But I'll try and remind you of that. So thank you for coming back from lunch. We're very fortunate to have an amazing panel, and as my daughter said, this is the only legitimate panel at this conference because it's the only one that has any women. So
it took until lunchtime.
Yeah. So I think we should get started. So each of our panelists, quick introductions. Seema is a technical director at the UK Endorsement Board, the creation of Brexit. Chiara Prete is the chairman of the Sustainability Reporting Technical Expert Group at EFRAG. Laura Girella is from the IFRS Foundation and leads their work, technical director on integrated reporting. Georg is the CEO president of the German Standard Setter, and Shari Littan is research director at the Institute of Management Accountants in the US. So thank you all for joining us. Now each of our presenters are going to provide a short presentation, and then we'll open up I'll ask a few questions and then we'll open it up to the floor. So I think Stefano signalled that after lunch we're really looking at, well, what are people actually doing on intangibles? And all these organisations are doing something, are leading in this space. So I want to start with Laura to give us the international perspective. So if we could just pull up Laura's slides. She just has a few slides to present.
Yeah, thank you so much, Mario, and thank you for having me today here. I somehow, in my presentation, would like to touch upon, again, using the metaphor that was used this morning by Stefano, the past, the present, and the future, also when it comes to intangibles. So if we start from the past, while the slides will be coming, let me remind us that, yeah, there is no update standard on intangibles today, let's put it that way. Does it mean that companies have not been reporting on intangibles, and especially unaccounted intangibles? The answer is no. And this is also thanks to what we have been doing almost 10 years ago with the release of the International Integrated Reporting Framework. In the International Integrated Reporting Framework, you can easily see that it is a multi-capital type of approach, which is based on 6 capitals. If we can go to the next one. Yes, please. Which is 3 of these capitals are related to intangibles. So human capital, social and relationship capitals, and the organizational or intellectual capitals. So this means that basically since the last 10 years or so, or even more, for those companies that have started to produce some form of integrated report, they have been disclosing in different parts of the report information on unaccounted intangibles on this type of resources. There are still some of misconception when it comes to intangible capitals. also in relation to the integrated reporting framework. So this morning we have been talking about conflating and confusion between ESG and intangibles. So as I was mentioning before, in the framework we do have social and relationship capital. So some of the questions are about whether that type of capital is the one that is used in the CSR report or sustainability report or not. And the answer is no, because as it was mentioned also this morning, when it comes to integrated reporting, first of all, the integrated reporting framework is aimed to providing useful information to providers of financial capital or users. And the other thing is that it really assumes and starts from the perspective of value creation, which is broader. What does it mean? That, for example, when it comes to human capital disclosure, you will have, yes, information about the well-being of employees, but also the training of the employees, the capabilities, and the competencies of the employees. So this is just to start with the past. What is happening now and what has happened actually in the last couple of years? We joined, as I was mentioned before, the IFRS Foundation. So now the integrated reporting framework is a joint resource between the IASB and the ISSB. This meaning that basically I'm speaking under the control of both Andreas and Richard here. But in doing so, it is also important to remind that both the IASB and the ISSB really see this framework as a joint resource. And both of them, to some extent, there has been work that both of these boards have been doing in relation or building at least on the framework. So the ISSB and especially IFRS S1 in paragraph 2, when they refer to the concept of sustainability, when they refer to sustainability risks and opportunities, it has really built on the concept of value creation as in the integrated reporting framework. And so the concept of sustainability, once again, it also embeds information on intangibles. So the three capitals that I was mentioning before. When it comes to the IASB, we have also been doing some work together with the IASB, and especially when it comes to the management commentary. In this year, some months ago, actually, we have been also analyzing the similarities and differences between the management commentary and the IR framework, pointing out to the fact that in both these two documents, there are more similarities than differences. Just to finish on the future, what the future is going to look like. Couple of things. One is about that we have been issuing as part of the ISSB, or at least coming from an ISSB side, a request for information in May this year, which basically was listing 4 potential projects that the ISSB could start, not finish, but just start in the next couple of years if they are included in the work plan. And actually, the first one was about biodiversity. The second one is human capital, human rights, and integration in reporting. If we just look at the last 3, they all deal with information of intangibles, because it is about human capital, human rights, and integration in reporting. So it is also interesting to see, if we can now go ahead with the slides, that the ISSB have started to discuss the feedbacks that we received for the request for information last month. And actually, it was interesting to see that both human capital and, next one please, okay. Human capital and human rights were indicated as single project by a few respondents, while if they have to be included as more than one project, so if the ISSB has to start more than one project, they are both indicated at most, which is quite of the contrary when it comes to integration and reporting. Clearly, the ISSB will continue to discuss about what to do with this project. So this is not just the final stage, we are just at the beginning. But this already provides you with an overall idea or where we stand with potential projects on some of the intangibles. When it comes to integration in reporting, we still is about it. It's going to include information on intangibles. We are going to have a discussion in January with both the IASB and the ISSB. So stay tuned, because yes, it is still possible to disclose information on intangibles, and let's see what the future will look like. I don't need it at this point.
Chiara.
Yes, I need it.
Thank you. Thanks, Laura. Apologies about those technical difficulties. If we could load Chiara's slides, please. If we could load Chiara's slides.
So from our side, we started to work at EFRAG as financial reporting on intangibles with the project that started in 2018. And then we should, if you go to the next slide, we should discussion paper in 2021. It's me. Fantastic. So it's okay. So in the discussion paper, I think you may have seen this in previous presentations. It's just a refreshing before I introduce what are the recommendations that we issued in 2023. So we started from the observation that intangibles is broad, that encompasses several different things. So it's a big asset class with several different items. And so it would have been difficult to imagine one solution that would have addressed all the different issues that exist, and for all the different type of analysts and all the different type of assets. So the intuition was to go with a combination, a puzzle of different solutions. So we explored possible changes to the recognition and measurement in the primary financial statements, not without some reluctancy, and then two other chapters on disclosures in the financial statements or in the management reports. Chapter 4 focused on information related to specific intangibles, which would provide financial and pre-financial information useful to determine their value, so the value of those intangibles. And then in Chapter 5, there was a more broad concept which came from interaction with users about a more narrative storytelling about the risks and opportunities financial risks and opportunities related to intangibles in the notes or in the management report, and also an idea of more granular information on future-oriented expenses. So at the end, when we issued the recommendation following the consultation in 2023, the recommendation that we have toward the ISB when they approach the topic is to consider a combination of the different approaches, because there is no one solution that could solve all the issues for all of them. In terms of recognition, very briefly, the idea was to broaden a little bit the scope of recognition, but in a selective way, because we didn't want to suggest to depart from the conceptual framework. So still in the remit of what is possible to be recognized in principles now, but still with some more flexibility, removing some of the rigidities that currently exist. But what is more important for the conversation that we're having today is the bit on the disclosure, I think. So the one chapter would be, one possible approach would be to include these financial and pre-financial information about the intangibles that are key to the entity's business model. So to support the understanding of the timing and amount of future cash flow, and from a management stewardship perspective. Same thing for the future-oriented expenses. I've seen the concept of intangibles in the slides of Seema, and that came out also in our advisory panel of intangibles. And in fact, for those type of intangibles where it's not possible to separate their benefits from the rest of the combination of assembled workforce, reputation, and so on and so forth, these disclosure about future-oriented expenses would provide a concrete help. This is basically a more granular breakdown of the expenses to try to understand which of them will provide their benefits more in the future. Now, we also had in these recommendations following the panel something on connectivity, because basically any solution from the financial reporting issues should also take into account the current development that are occurring in sustainability reporting. And the third element that I mentioned in the chapter of our discussion paper around risks and opportunities is clearly the one that most resonate with what is now in our ESRS and also in what is in IFRS S1 and S2. So that's the element of the solution for intangibles that will sit outside the financial statement but will sit in the sustainability statements. And the majority of the respondents expressed the view supporting this disclosure. Now, the paper was not suggesting where they should be located, but in the meanwhile, we have issued the ESRS, and so we have clearly them covered, at least for those that are related to sustainability matters, covered in sustainability statements. And now, clearly, what we altogether need to work on is connectivity, which now means different things to different people. So first, we need to do some homework now as a standard setting, in particular, in terms of terminology, because it may mean touching upon a conceptual framework for sustainability statements, or it may mean coordination in products or coordination in process, both for companies preparing the reports and for standard setters, and then it may mean integration in reporting and connected information. And here, and I like a lot what Laura said as an introduction, when EFRAG responded to the letter on the agenda consultation of the ISSB earlier this year, what we suggested is that they start immediately from connected information, because that is what is immediately needed. We have new concepts in ESRS, in IFRS S1 and S2, and we need to put them in practice. And we also need some more practice with the sustainability statements and its content and where to put information before we start thinking about the integration in reporting, which is some more fundamental rethinking about the borders of the two dimensions. Now, I think I will be quick here. On our project on connectivity that EFRAG is doing, the purpose is to issue a discussion paper in 24 or 25 on how to implement the current concepts of connected information in IFRS and ESRS, because it's the same. It's basically about producing information that is linked between the various documents where it is sitting. So it's in the sustainability statements, it's in the management report, it's in the financial statements, and altogether we need to basically illustrate the linkages. And this is the purpose of basically the project. There is a concept of direct connectivity, indirect connectivity, and consistency of data and assumptions. I mean, these you can find more reading in the ESRS, but they are all the same that they are in IFRS, and we are going to work on these elements in practice. So to conclude, in the financial statements, we will need enhanced disclosure on intangibles that are key to the business model. So the focus here is in value creation for investors from a financial perspective. And this may be addressed by the two solutions that we proposed in the discussion paper. So the information on key specific intangibles and the more granular information around expenses. Then in the sustainability statements, you find the financial risks and opportunities related to sustainability matters that are likely to have an effect on value creation. It means cash flows, financial perspective and position in the short, medium and long term, but also cost of capital and access to capital. But also and this is important, we were looking for guidance when we were writing the application requirements to EFRS 1 on how to perform the materiality assessment for financial angle, so for financial risks and opportunities. And of course, the obvious reference was the integrated framework. And we included some application requirements with the language around so undoubtedly it will play, it plays already a role to help to conceptualize all these things. So I will conclude here. Perhaps I was a bit longer than my 7 minutes.
I know.
I may be shorter in the second round.
Thank you, Chiara. And Seema, over to you to talk about the UK Endorsement Board's work on this topic.
Thank you. So whilst the slides are hitting, thank you, Mario. Really pleased to be here to just share some of the work of the UK Endorsement Board. And in particular, I just wanted to talk about intangibles, sustainability, and actually how we're looking at connectivity. So whilst I do that, if you would allow me to give you just a brief intro to the WICI, because if there was a dividend to Brexit, I think probably we are it. In that we are a new body set up post-Brexit to actually formally adopt IFRS for use in the UK. At the time, there was no sustainability board. Therefore, even in the legislation, it says IFRS. Subsequently, it has become clearer. We have IFRS accounting standards and IFRS sustainability standards. And as a result of that, actually, the WICI's work, whilst it started off by having two statutory functions of influencing the IASB on its work and formally adopting the standards, subsequent to that, actually, government has come forward and asked the WICI, together with a number of other financial regulators, to actually formally consider influencing the ISSB. And this is sort of an interim measure whilst the government is actually busy trying to work out what the UK framework for adoption of ISSB standards is going to be. So if you were to go onto our website, I will heavily encourage you to do so, you will see there are 3 different types of projects that we undertake. So endorsement, obviously, I think is probably fairly understood in that we follow a similar framework to the EU in terms of formally endorsing and then adopting the standards. The one difference between the EU and the UK here is that that work is split between EFRAG and the Commission. In the UK, the Endorsement Board is the formal body that actually does all of the work and then formally adopts. Once it's adopted, it is part of UK regulation. Our influencing work in particular is supposed to be underpinned by a lot of research, which is where I'm going to go now. But as we became used to having to influence the ISSB as well and starting to consider their work, a lot of our work has now focused on actually understanding that remit, which is very much focused on connectivity with accounting standards. So we're sort of, unlike EFRAG, we are slightly at the starting blocks of trying to understand some of this. So what I share with you now, hopefully will be taken in that context. So from a WICI perspective, we've got a live project. One of the earliest research projects the board actually decided to take was on intangibles. And our live project is on intangibles. It's a multi-phase project. We've got 2 phases at the moment, as far as I'm aware. So the first one, we actually published a report in March 2023, and I'm going to give you a little bit of an update on where we are with that. And then there are, in the future, we've got 2 other reports planned, I think in March 2024. So the first one is very much about what our UK stakeholders' views are on intangibles. And the other 2 are going to focus on more how UK companies are reporting on intangibles at the moment. And then a third one is based on a survey with investors in the UK to understand what the specific investor view is on some of those detailed intangibles. So I think going forward, right. So the first, this is a summary of the first report. On the first report, our focus was to actually interview, I think we took about 35-ish stakeholders across the range of the capital markets to try and understand their views on intangibles. And this will not come as a surprise, having heard everything this morning. Intangibles, definitely there is a very keen interest in that because of the very significant increase in economic importance. But very, very clearly identified the fact that it's quite difficult to work out how to recognize them and measure them from a financial reporting, in particular accounting perspective. Having said that, nobody beyond that, they didn't come up with a single problem or a single solution. And that makes things that much harder, and that's one of the reasons why we are undertaking more research in this space, because depending on who you talk to, you come up with a slightly different definition of the problem and the solution. But there is most definitely an appetite for enhancing recognition of intangibles among some stakeholders. And then when you talk to investors in our initial discussions, very clearly there is a focus on wanting more disclosure. So then we looked at the economic significance of intangibles in particular, and they are clearly economically important. And from a UK perspective, what was really interesting was that if companies don't report intangibles on their balance sheet, it has a direct impact on the national balance sheet. So if they're not reported on the company balance sheet, they are not reported on the national accounts either. And the UK's move towards a knowledge economy has really had, there's a growing investment in all types of intangibles. It, in fact, when we looked at the numbers, it's surpassing investment in tangible assets in the UK. So in the past 10 years, amongst the FTSE 350, those of you who don't know, 350 is sort of the 350 largest listed companies in the UK, intangible assets have nearly tripled in value in absolute terms, so from 115 billion to 330 billion, and then nearly doubled as a share of total assets. So from our perspective, I think we knew that we had to get a handle on how we overcome this invisibility. So we, as we are doing, went back to stakeholders to try and sort of understand a bit more, and this is what Chiara was talking about, tangible versus intangible and tangible intangibles. So our stakeholders see intangibles existing on a spectrum. So there is very much on the one end, you've got the tangible intangibles. So these are patents, cryptocurrency, which I always find interesting when people say that that's one of the ones to think about, software. And these are, I think, the way we thought of these are ones where you can actually delineate in a legal or market sense that there is an intangible of some description. But then on the other end, you've got the intangible intangibles. There's a bit of Donald Rumsfeld. But these are the less clear, they're much more closely related to the intangible capitals that we've been talking about. So the human, social, organizational, intellectual, etc. So in this context comes up training, knowledge assets, customer relations. And what we do know, however, is that all of the stakeholders we talk to, they see difficulty in capturing this information in the balance sheet itself. But users definitely see value in having that information in one way or the other. So just to very briefly illustrate this, so in the context of training, so companies make significant expenditure on workforce training. So when we looked at the UK companies, 33 out of those 350 actually provided separate information on training in 2021 accounts. So they spent about 406 million together on training, and that's an average of about 3% of their profits. But many of our stakeholders actually argue that training can be treated as an asset, as it is often directly related to services delineated by companies. So unless you've got a trained staff, your services are not being delivered the way you would want them to be. But even if these types of intangibles are not capitalized, I think the stakeholders are wanting to see granularity of disclosure, as it's not a surprise. So how does connectivity come into it? I'm sure you're wondering. So I think it's here that the connectivity with the sustainability reporting comes in, because the information value from the sustainable information actually is almost acting like the bridge. So when I say to you it's a spectrum of intangibles people are seeing, I think there is very clearly a view that some potentially sit what we in the UK colloquially call the front half, and then the others potentially sit in the financial information, and it over time emerges from one to the other, potentially. And this is my hypothesis, yet to be tested. And I think, so prospective information that focuses on organizational resilience, drivers of future value and management of risks and opportunities, potentially sits within the sustainability piece. Some of those tangible intangibles may be the ones who land in the financial accounting piece, but the measurement question still is there. So I think one of the things that I think for us was quite clear is when we considered the ISSB's agenda consultation, that human capital as one possible project actually would address something like training, for example. But the extent to which you recognize that in the financial statements is a bigger question. And then when Andreas goes and thinks about it in his project, I'm sure we'll look forward to hearing how that goes. So I think I will sort of go so far as to say it is a bridge that forms a coherent story about the company as a whole, rather than looking at two individual pieces, sustainability on the one end and financial accounting and reporting on the other end. In fact, the two are linked in some way or other, and it may start from sustainability but emerge over time into financial reporting as we are more able to measure, recognize, and actually report much more clearly on some of these matters. So I think I'm not going to linger much longer other than to encourage you to go and look at our website, because not only this work, but actually a lot of our work on connectivity, we have a number of papers on that, are all on our website. Please have a look, and more to come, as I mentioned earlier. Thank you.
Thanks, Seema. Georg, the German standard setter has also been very active in terms of considering how to transpose this requirement in the CSRD, and could you tell us a little bit about your work in that space?
Yes, delighted to, Mario. Let's see whether we've got some slides. And yet, after everybody had some slides, I also produced some. Only 3 or 4 in order to keep it not too long in the end, and keep also a little of time for discussion. The Commissioner, Eric van der Plas, mentioned earlier on some expectations from the Commissions on intangibles and what is up just for doing just now in terms of like rolling up our sleeves and get things going. And there's one provision also in the CSRD that mentioned also Chiara in the end, where I think that we have to see now how it moves. Where and I think this is simply perhaps good to see this also a bit more, I would say, one-to-one in the end, where we have actually now some requirements to do something. The interesting part, it's not part of this big, immediately ESRS debate. So it's certainly something distinct in terms of like where it is placed in as a reform. Initially, I think there had been a lot of thinking around putting intangibles as part of sustainability reporting. However, it turned out also that thanks to the, would say, legislative discussion in council and parliament, in the end, it ended up in the financial part of the management report. This is, I think, in the end, quite telling. In the end, is what needs to be done around that. We, as a German standard setter, perhaps also a little bit of background, we reformed ourselves back in 2021. Already in this format of financial and sustainability reporting, and also decided at that point in time already to look at things in the end from a dual perspective, and perhaps also to note in that respect that we had done already at that time. There were two things that we wanted to look at. It was once climate reporting, and the other thing was intangibles, and also partly certainly sparked off by that European debate, and in the end to simply say, okay, we have here some issue. We don't know yet exactly how this will play out, but this is going to be important. Via the location and the management report, the financial part, we certainly have also here an ask for national standard setters. That's why you're sitting here and why we've done also part of this next report that I'm going to show you later on. Some considerations, what is the basis for such a kind of discussion? We know that it's going to be affecting a lot of companies again, in the end, where I think they are also seeing, a lot of burden at the moment. In the end, if you say we have to implement CSRD, this is not light touch. This is, in the end, a heavy exercise where also we have to simply see how we can place this in that debate. And thereby that we have, for the first time now, really included this intangible resources as a term, as a kind of concept now in the directive. We also have in the end to spend something around that. We still in Germany waited for the, implementation of the legal, from the legal side to simply say how can we change German law, and what we can expect certainly is something that quite. Not further telling in the sense that it's going to be one-to-one transposed into German law. There had been some earlier, leak drafts, which in the end showed that this way. So I think it's important also to think about this from a national perspective, how to fill this with life, and in the end give some sense to it. So looking at all these kind of considerations in the context of this legislative move, certainly also desire simply to keep it, but nevertheless the sustainability link. And this is also certainly something where I think basically it had been, if you take the original idea from the Commission, was to simply, okay, we tell the story of transformation. And this is certainly something also to consider if you say, okay, what could be an aspect in the end bringing this to life. So what we've done, and this is certainly also getting a little bit of attention to that, because we've seen a lot of, coverage of sustainability reporting as such, which contains, of course, aspects. We heard this earlier on. But in the end, what can we take from that? And this is not only in the end about ESSs. We have got, a decade-long now experience, and also in the fundament in the end of ideas around in the end intangible reporting. To make this in the end also as some findings, some would say in the end information for the German audience, and this is in this way also only in German language. So in the end, this is also for the German audience. Simply to say, okay, there is WICI, there are national initiatives, and in the end prepare them for, an informed debate about, in the end, what makes sense in the German context. And you can see this also by the questions covered here in that report. In the end, looking a little bit again at history, but also in the end trying to put on the table some, the basic questions. And what we experienced in an event in Berlin, then also discussing that report with the public, and we've done this here in conjunction with Bertelsmann Stiftung, in the end, who also supported this a little bit financially. That we found here finally, I would say, is a starting point also for our thinking in the end if we enter into standard setting, because we need all this by, in the end, for the financial year already 2024. So we need something in terms of also orientation by early 2024 at latest in order to inform the debate. Unfortunately, the legislative process will not end before mid-2024, so it needs to be at least ready by that time so that we have some kind of a proposal. So perhaps some of the outcomes of this discussion, and this perhaps can also help that, and you say, okay, how can we roll up our sleeves? There's one certainly about certain unclarity about what is in the end intangibles, and I think there's a lot of a bulk of wealth in terms of like what we've seen in terms of categorizations, being WICI, be it other initiatives, in order to inform in the end those who are getting something quite abstract, in order to say this is the universe that you can imagine in the end to be reporting under. There's certainly also a need to really focus, because it's in the end the most important only that aspect that should be reported in terms of kind of value drivers. And you find also some buzzwords which I've seen also in earlier presentations, like we talk about business models, and there we have got this, and you see this also as a kind of transformational aspect. Is business model something static? Probably not. We talk about value drivers? Yes. So we see in particular some value in order simply to tell that story of transformation in particular via this kind of provision, and also bringing this to life in the end to say, how can I deal with this what kind of value drivers, what are the immaterial resources that finally make that up? And in the discussion, you've seen that in the end, such kind of more strategic angle on this would say reporting requirement it's much more attractive at the moment than I would say going deep into monetization or further I would say performance measures in order to in the end bring to life certain aspects. Of course this can help in some instances, but it's going to be narrative. And what we've seen certainly also in the light of the wider, let's say, burden projects that are there at the moment. The CSRD is not the only one, only game in town. There's also BEPS Pillar 2 and other things that are at the moment quite heavy projects for company practice that we certainly aim at that direction if we now embark on standard setting. And we need to be ready already by spring next year in order to simply communicate on what we imagine in terms of as a solution to this. However, the finalization will take into the second half of 2024. Perhaps I stop here. I have not used every slide now, but in the interest of time, that is fine for you that we don't do that full length.
Great. Thank you, Gail.
Thank you.
And Shari, if we can now turn to you to give some management accountants' perspective on how to think about intangibles.
Yeah, so I'm glad to be here, and I like to take a little bit of a step back, and I'm kind of a big picture when I think about these things. And I'm going to start, and I'm going to refer to a conversation that Georg brought up earlier when he said, it's not rocket science. So I'm going to start. Humans are not comfortable assessing risks and probabilities, yet these are the core measurement tools that we need to think about intangibles. I'm actually going to quote from a rocket scientist by the name of Neil deGrasse Tyson, an American astrophysicist. In his most recent book called Starry Messenger, he has a chapter on risk and reward. And he writes, "The human brain is woefully inequipped to think statistically and probabilistically about the world. It's not our fault. Probability and statistics was one of the last branches of math to be discovered. It was discovered after calculus. The first time anyone thought that it would be a good idea to take an average of numbers was in the 1800s. Thinking probabilistically is not natural." So we're here to talk about connectivity between sustainability and financial reporting. From the conversation over dinner last night, I heard that there are those that don't understand connectivity or don't even want to see it happen. But I would say from my observation and conversations, the world doesn't really want siloed corporate reporting. They really do want to see, for the most part, a single story, a connected story. And yet, we're here listening to debate after debate for the right framework. What is the right framework that we should be using? Should it be siloed, and how do we get them together? Now, earlier this year, I was the lead writer in the COSO Internal Control Integrated Framework. applying it to sustainability reporting. And what we thought a lot about was risk, because all this new types of reporting brings about risk. And where's I go to my first slide? Yeah. And which one is it? Oh, this big one. There we go. So when we think about informational risk and bringing all this new reporting in, we think about there are key differences between financial reporting and sustainability reporting. The first one is boundaries. We all know that under US GAAP and IFRS, there are standards that tell us what a consolidated entity is, and it's largely based on the equity ownership. That's how it's been. But when we get to sustainability reporting, it's a different boundary. We're looking at influence and control. And so that creates informational risk. Am I going to go to new third parties and rely on their data, which is not mine? We think of the Scope 3 question, right? I have to include Scope 3, but it's not necessarily my data. So that's one thing to think about in connectivity. But the second and third categories are the ones that really strike me when we talk about intangibles. The second one is measurement. In financial reporting, we look back to the exchange of goods and services, and that's how we measure and put transactions in the financial statements. But in sustainable business reporting today, much of it is still qualitative. Why is that? Because we don't necessarily have good measurement tools that we trust, that we rely on. What's the right KPI? And we'll hear 3,000 KPIs or 10 KPIs. And what KPIs are decision useful? Someone said this morning, no one manages a business at 3,000 KPIs. Is it decision useful? So we don't have the right tools for intangibles to do this kind of measurement, which is why we need all the academics and the smart people to figure out how to do that. When we think, and the third one, which ties right into that, is the idea of prospective versus retrospective information. Traditional financial reporting is largely historical. We looked at historical costs, we had a transaction, we put it on the books. But by its very nature, sustainability is about the future. It is about the ability to access resources. It's about the willingness of stakeholders to contribute those resources to the organization. And this is where it gets really, really tricky in how we come about to connectivity. Because what we're really talking about is the concept of measuring expectations, which is something that traditional accounting is not comfortable with. But that's where we're going to need to go to think about really getting to a place of connectivity. So when I think about the various models, and we're talking about building blocks or overlapping circles, one thing that I like to think about, I've kind of rethought in my own way building blocks. Because in my view, I think that there is less disparity between impact accounting and traditional. I think that obviously financial investors are looking for the expectations. They want to understand what other stakeholders are contributing to the enterprise. And they also want to know what's my stake in that. So even though I would never suggest to any of the standard setters to think about the hidden balance sheet and the totality, when I need to explain single materiality, double materiality, I turn around and, when I was in law school and we were given case studies and they say, analyze these facts, I would be drawing T accounts because that was my background. Same thing here. This is Shari speak in this model here, because this is how I reconcile. I say, okay, I have my financial statements. I know what IFRS or US GAAP lets me put on. But they have all this other resources, and those resources are being contributed by other stakeholders. If I change the idea of investor to the idea of contributor, I'm back to the historical underpinnings of where financial accounting started, what a balance sheet represents, the totality of resources that stakeholders and contributors said, okay, I'm going to let go in our economy. I'm going to trust that this entity will use these resources wisely, and I want something in return. And this applies to customers, to employees, and to the community at large. There's a reason that governments representing various communities, nature, they stand and they say, okay, you can use our resources, but we want some measure of performance in return. But we go back to that idea of expectations. When we talk about intangibles, we're talking about the future cash flows or future non-financial returns, some amount of performance. And that means having a movement, an evolution, and I'm not suggesting, as we heard earlier, that this means we're going to go and start capitalizing everything. Like I say, I use this conceptually, say, okay, what's not here? And maybe we should be identifying more of these items and figuring out how to measure them. But in order to measure them, we're going to have to get more comfortable with tools about assessing the future, measuring expectations. We can give examples in financial reporting. When I studied accounting, we couldn't measure our portfolio at fair value. We used something called lower of cost or market because we didn't trust the information. Later on, we had the debate over stock options. Can we measure stock options and put them in the financials? Well, we found Black-Scholes, and even most recently, we have the Cecil model. I deal with a lot of preparers who are out in the field who have to implement all this and thinking about informational risk, and they say they were out of their minds when Cecil came out. They said, oh, we're going to have to build new models for losses, and they went ahead and did it. So in evolution, the more comfortable accountancy becomes with, we talked about claims, insurance. We have insurance account, we have actuaries. Maybe we need more risk managers in the room. Maybe we need people who are doing modeling so we can get comfortable with intangibles and think about measuring. And maybe some of these items will move more towards a fair value or a measurement technique that we heard earlier today. But the discussion over framework, I think if we put our resources and our minds toward measurement techniques and getting more comfortable with measuring expectations.
Thanks, Shari. Okay, we have a few minutes left for questions. So any questions from the floor? Maybe I'll just kick us off. Chiara, can I ask you a question? Because we've had a lot of discussion today about integrated reporting. And I think one of the things that's not clear for some people is with the idea of a sustainability statement, can you still prepare an integrated report if you're a European undertaking? So maybe you could shed some light on that.
Yes, thank you. So the question is very pertinent because clearly with the choice of the CSRD of placing the sustainability statements in a subsection of the management report, coupled with the requirement in the IFRS about the structure of this report, where you have a general chapter and then an E, an S, and a G, then the question is very pertinent. And the key to this is the paragraph in ESRS 1 about incorporation by reference, where we allow to incorporate by reference disclosure requirement or information data points from other documents, and we mention other section of the management report, financial statements, remuneration report, Pillar 3 report. So it's not an infinite list of, so it's not a free-for-all. There is some discipline. The parts that is incorporated by reference needs to be audited with the same type of assurance that you have in the ESRS sustainability statement, and also in digital terms, it has to be available with the same technology. So there are limits, technical limits, and the last limit is that you cannot transform the sustainability statement and an index incorporated by reference everything. So it is still to be comprehensive, understandable, with the qualitative characteristics. So yes, you can incorporate some components. What does it mean? And there is an illustrative example, Appendix G of ESRS 1. There can be an integrated executive summary in another chapter of the management report, which is the executive summary of integrated reporting, is prepared in that way. And then when you, in ESRS, prepare your SBM 123, which is a strategy business model disclosure, then you can incorporate by reference elements from that document.
That's very helpful. Thank you. Thank you. Any questions from the floor? Please.
Hi, I'm Dennis Denoncourt from Nottingham Law School. I was wondering, from a corporate governance perspective, we do have the concept of comply and explain if we're not going to adopt certain of the legal requirements. Do you have a view or examples that you'll be able to share with preparers in relation to if they have to go down that route, maybe because they have a scenario, a model that they've worked up that doesn't turn out to be the way they expect? So that comply or explain aspect to this debate, I think, is going to be very important in the transition years.
Does anyone want to pick that up?
I spoke already twice, so I leave Seema.
Okay, I mean, okay, shall I answer this one?
Seema, please.
So, Janice, I'm not sure that I'll do justice to your response, but to your question, but just in response, I think in the UK, we already have examples of comply or explain. So when it comes to, let's take the example of S2. As and when we come to formally adopting for use in the UK, actually the companies that are already accounting for TCFD on a comply or explain basis have a shorter distance to travel to get to S2. So I see that as a good example of using comply or explain as an interim sort of milestone to some extent to get to mandatory towards the end. And that's sort of long-standing concept in the UK anyway, because we've always gone from guidance to sort of encouragement to comply or explain to then formally mandatory, rather than taking one giant leap to mandatory reporting on a really huge scale.
Like Europe is that.
Sorry, Chiara, did you want to come in?
No, yes, like Europe has done, in the sense that we thought about this approach. In the ESRS, the remedy when the information, when the estimate is too much uncertain, is the disclosure. So you disclose your sources of uncertainties, to what extent you could remediate to the uncertainty, and the remaining level of inaccuracy. So what is the accuracy level that you reached?
Thanks, Chiara. So we have a question online. Michelle.
complete discussion that is going online, but we will share it with all of you, because what I see is it's very interesting, but it will take us out of the time frame that we have. But I asked the technicians here, they will share it with us so we can see the discussion that is ongoing online from people from, well, let's call it around the world.
Okay. Great, great. We look forward to that. So please join me in thanking our panel today with excellent insights. Thank you. Okay, so now we move to our parallel sessions. So some will be in here, the rest on the 4th floor, down the hallway, and then there's a lift or stairs if you wish.